morning. Parker Gerard here with Evolve Advisor Group. Thank you for joining us here on our Q2 market review. It's a lot to talk about today. We'll start here with tariffs. I think this is what's on everybody's mind. And we're including a chart here that we've had in a lot of client meetings here recently, which is just the history of tariff rates really going back to 1901. And we see generally over that time that tariff rates have come down. We do see here in 2018, the Trump tariffs 1.0, where we did see tariffs increase here marginally. And then we see what happened here on April 2nd. This is a big difference than what we saw back in 2018. These are not the same event. This is just a significant increase in tariff rates that we've had previously. And we understand that this is a bit of a moving target at this time. We know that some of this has been rolled back, and we do expect further changes here with tariffs here going forward. But this is what was proposed here on April 2nd. Now, what were some of the risks here? What are some of the risks here in markets? And if you're on our call here earlier this year, or you watched the video earlier this year, you would have heard us talk about the Magnificent Seven and some of the headwinds that we expected from those companies, really due to just the high valuations that they had. When we look at the Mag 7, and we actually use the top 10 companies, it's kind of easier looking back in history. But if we look at the top 10 companies' valuations right now compared to the rest of the market, we're seeing that the top 10 companies are actually trading at valuations 11 times more expensive than the rest of the market, which this is the highest that we've ever seen. So this is the largest spread we've ever seen between the top 10 and the remaining stocks. In addition, these top 10 companies are still extremely concentrated. They make up still over 30% of the S&P 500. So you pair high valuations with concentration, and then we add in some type of catalyst event like we've seen recently with tariffs. So you add in uncertainty, and that really does explain here the return environment that we've seen so far this year. Equity indices are down, and leading the way have been the Magnificent Seven, down 18% here on the year, likely due to those higher valuations. U.S. markets down 7%. And then our international developed markets down about half as much, down 3.5%. And I know that international markets are down, but they are outperforming U.S. markets so far year to date. In fact, if you go back into March, developed international markets were actually up about 9% on the year. So with some of the tariff news that they have come back down to earth, I'll talk more about international here in a second, but I think there's a narrative building overseas. And then a bright spot here within markets has been the bond market. So the U.S. bond, U.S. Ag index, up 1.8%. And when we're building out portfolios, especially for clients who are currently retired, about to be retired, we're adding bonds with it to the portfolio with an effort to de-risk the portfolio. And so it is really encouraging here to see that as equity markets have fallen, the bond market has actually increased and done very well and held up during some of this equity volatility. A couple more points here on international. Yes, they have outperformed U.S. markets year to date. But despite that, there's still a very attractive valuation story happening with international, to the point that international stocks are actually valued at a 30% discount here to U.S. markets. So pair in the valuation discount plus this catalyst that we've been seeing with the recent uncertainty. I think there's a narrative building here to have international equities within the portfolio. For most of our folks on the call, we've already had international in the portfolio. If you're not working with us currently, now might be a good time to ask your advisor how much international is in the portfolio. Now, we've had a lot of uncertainty. So what does that mean? How are we building portfolios? What do we need to do to get through some of this uncertainty? Well, whenever we can't see the hand in front of our face, we always want to come back to diversification. Diversification really is the core tenet to how we construct portfolios. It's the warm blanket that we add on the portfolio. Simply by adding different asset classes can help provide a smoother return stream over time. It helps us reduce uncertainty, helps improve outcomes for folks to have diversification within that portfolio. Furthermore, adding international into the portfolio is another way to diversify, especially if we have some challenges here domestically, including a weaker dollar. So, a couple points on the dollar. The last half decade, the dollar has been very strong, but so far this year, we've seen the dollar weaken slightly. And a weaker dollar actually acts as a tailwind for us to invest internationally. So think about it. Everyone on the call here is in the United States. We invest with our U.S. dollars, and if that dollar is getting weaker, it makes a lot of sense to take that weaker dollar and exchange that weaker dollar for a company denominated in another currency. And so that's just another reason I think to have international stocks within the portfolio is that weaker dollar helps strengthening that international narrative. Also, adding bonds in the portfolio can help reduce volatility. I know that bonds have been a drag on portfolio over the last couple of years, but for our clients that have stuck with bonds over the last few years, listen, everybody's that has bonds are really happy that they have them right now. Last point on diversification. Listen, a diversified portfolio is not going to outperform every single market. It's just not. It's not built to do that. But it is built to reduce volatility. That's why we do it. And so the last couple of years, diversification really hasn't worked, but diversification is much more, it's back in style, you could say, for 2025. Where to next? And I think it's important to put this drawdown here in perspective. What we're looking at, all the bars on the chart represent how markets returned in that calendar year. And one of the things that jumps out at me is that there's a lot more up returns than there are down returns. And then the dots represent the max peak to trough drawdown during that calendar year. And what we can see is there's always a drawdown. Every single year, we see some type of drawdown with U.S. equities. And really, on average, we see that drawdown be about 14% per year. And so the last couple of years, we really haven't seen major drawdowns. We haven't seen major uncertainty. And I think folks got lulled to sleep a little bit based on the returns in 23 and 24. Things just kind of went up and everything was rosy. I would tell you those years are more anomaly type years. Those are non-normal years. What we're seeing this year, so far, a max drawdown has been 19%. That's a little higher than average. But I would tell you this year is much more normal as an equity investor. Volatility is the norm. We've seen it in the past, and we're going to continue to see volatility into the future. So we just really like to set that expectation. And listen, we don't have to think that far back. COVID wasn't that long ago. In March of 2020, we saw markets fall about 30%, a little over 30% in 1 month. And there were some really bad days in that month. We see 3 in particular where markets were down 8%, 10%, even 12% in a single day. And we've seen this before. If you might remember 2008. You might even remember Black Monday in 1987, where markets were down 20% in a day. But for our clients and for our investors that stuck it out, you typically fared well. What we say a lot in this office is it's more about time in the market, not about trying to time the market. And so for those of us that stayed invested, your trailing 12-month returns looked really, really good. And what we see in the long term is that we believe in stocks for the long run. We really do. So here at Evolve Advisor Group, we do believe in markets. We understand that there will be periods of volatility like this. But what we typically see is that stocks, yes, are the most volatile asset class in the short term. but in the long run, they are the most stable. And so, as we're building out portfolios, typically with stocks and bonds, we do believe in them in the long term. We're not going to try to answer the timing question. I know we have some uncertainty right now. When is it going to end? I don't know. But we do know that eventually it will. Stocks will gain their footing, markets will gain their footing. And for our long term investors, typically fare much better than the short term investor. So I know that I covered a lot just then, and there's a lot of uncertainty and a lot of noise out there right now. So if you have any questions, please feel free to reach out to us. I have our contact information here on the screens for me, Ryan, and Brendan. Please feel free to reach out to us at any time. We'd love to set an appointment with you, help answer your questions, calm your nerves, and help you get through this period of volatility right now. So until next time, thanks again for watching here our Q2 market update.